Okay, good afternoon and welcome back to our options education webinar series. Today we're here to talk about debit spreads, one of the more efficient ways to gain a directional exposure in the markets with limited risk, which is why a lot of you are here. You have specific ideas in the market that you want to play out, but you want to do so or gain exposure in that stock or ETF in a way that has limited risk and you're not paying through the nose in time value by just outright buying a call or a put. This is a slightly more advanced strategy and it does require a basic understanding of buying calls or puts. But if you have a basic understanding of buying calls or puts, this is really a strategy that you should consider adding to your toolbox to make your trading more efficient, to impact your returns by boosting your returns by actually minimizing your risk. So today what I want to do is I want to keep things relatively short. I want to spend as little amount of time on the slides going through best practices, mostly just showing you the construction of this strategy and why it is a strategy you should utilize in your portfolio. And I want to spend most of my time actually showing you as many examples as possible. I'll even open this up for a lightning round at the end so that you guys can submit symbols and your views on those symbols, and we'll take a look at some of them to help you show you how easy it is to use options play to quickly find and evaluate these potential candidates to show you whether or not a debit spread is suitable for your specific outlook on a given stock or ETF. So let's go ahead and get started. Before I go ahead and jump into the subject, just a little bit of housekeeping. For those of you that are brand new to options play, the software that we'll show you here as part of the demonstration, you can get a free 30-day trial as part of options play. I'll include this link here at the bottom in the chat window for those of you that want to sign up for a free trial. Membership is only $50 or $500 a year. And as part of signing up for this free trial, you'll get a free 12-step options trading course that'll help you jumpstart your options education, including daily options trading ideas over your 30 days so that you can test out. And included in these trade ideas are these debit spreads that we're going to go over here today. So let's go ahead and get started, and I will come back to this slide at the end for those of you that want to sign up for this particular service. Now, I want to start off by talking about what are debit spreads, when should you use them, how to trade them effectively. That is the core of what we're here to explore using the slides. I'll talk a little bit about how to manage these trades once you're in them, but like I said, I want to spend as much time as possible using the actual software itself to show you how you can quickly type in any stock or ETF and quickly gain a directional view using debit spreads. Now, this webinar is recorded and we will provide the slides to you after we finish here today, so you'll be able to follow along at your own pace. If this is a relatively new subject for you, or if you're new to options trading, I highly recommend you to take a look at this recording as well as previously recorded webinars to learn more about options trading. So let's start off by talking about what is a debit spread. There are two types of vertical debit spreads that you can trade that we're going to cover here today. There's the bull call spread, or typically known as a long call vertical, and there's a bear put spread, also known as a long put vertical. So what I want to do is I want to talk about how to break down these trades so that you can better understand why debit spreads work the way they do, and hopefully give you a little insight as to why they are one of the most efficient ways to take a directional view using options. So first, we're going to use the bull call vertical as an example. Now, what I want to do is I want to first break this up into its individual components. I want to first talk about just outright buying a call, because most users are familiar with buying a call option. So I want to compare buying a call option to buying a call vertical spread to show you the difference between the two and what you're actually doing when you're trading a vertical. So for all of these examples, I'm going to use a fictitious stock XYZ trading at $100 just for easy purposes of demonstration. Now, let's say in this particular case, I have stock XYZ that's currently trading at $100. I'm bullish on the stock, meaning I think it's going to go higher. So what can I do? So if you were just a beginner options trader, you might have learned a strategy called a call option that allows you to take a bullish directional view on stock XYZ. So what is that trade looks like, where you might buy a 100 strike call, so the at the money call. Let's say that call option cost you $4. So this trade will give you a max loss as if the stock stays below $100 or lower. So if the stock doesn't move any higher, you will lose the $4 that you paid for on the call option. Your max reward is unlimited in this particular case. That's one of the benefits of a call option, is that you get dollar for dollar exposure as long as the stock keeps rising. And the break-even price of this trade is 104, which means that if I'm bullish on the stock, I have to be bullish enough where I believe it's going to go above 104 and further before this call option is profitable. So what I'm getting for a call option is I'm getting defined risk, meaning no matter what happens, even if the stock drops to zero, I'm only risking $4. I have unlimited upside, just like if I had bought a stock. However, I only make money after the stock goes above 104 or higher. Now, depending on the scenario you're in, a 4% move might be a lot in order for your strategy to be profitable. So sometimes getting that 4% move just to get to break even sometimes is quite a bit. And this is really one of the downsides to outright buying a call, is that many times it's expensive, and the move that the stock needs to move in order for your strategy to be profitable is not an insignificant amount. So that's why we want to consider trading a vertical to reduce that risk. So when we're buying a call vertical, we're doing the same thing. We're still going to buy that $100 call for $4, but now what we're going to do is we're going to sell a higher call against that. So here we're going to sell a 110 call, a call that's $10 above the current price. And for that, let's say we receive a $1 credit. So now the net of the whole trade, instead of paying $4 for the whole trade, we're now only paying $3 because we're paying $4 for the call. We're receiving $1 for selling that 110 call. So now our max risk goes from $4 down to $3. And in exchange for that, what we're doing is we're capping the risk. And the reason for this is because when we're bullish on stock XYZ, chances are we don't think it's going to go to 200 by expiration. We only think it might go up by $10 or $15, meaning there's a certain amount by which we think it'll go. So when you're buying a call option, you're buying all that upside. But in reality, we're not necessarily expecting the stock to move up to 120, 130, 140. So why pay for that upside? So that's what we're doing in a bull call vertical, is you're exchanging some of that upside. You're giving away any upside above 110, because at some point you have to say, well, I don't think it's going to go much further than that. And what you're going to get for that is you're going to reduce your risk. So now instead of having the break-even price at 104, now it's at 103. So not only do you reduce the amount of risk that you're taking on the trade, you're also lowering the break-even. So now the stock only has to move to 103 or higher before the strategy is profitable. And you have a max loss of $3 if the stock is below $100. So if you're wrong on your analysis and the stock stays where it is or moves lower, you will lose the $3. If it goes above 110 or more, you will receive your max reward of $7. So no matter what happens, even if the stock goes to 200, you're still only going to get $7. So what you're effectively doing is you're reducing your risk, and you're exchanging that unlimited upside in exchange for a lower risk and a capped upside. Now, the goal here is to really allow you to profit from a large directional move, a defined move in one direction or another here using debit vertical spreads. So that is an example of how you would deploy a bullish viewpoint using a debit call spread. Now, conversely, if let's say we're bearish on stock XYZ. So here I'm going to do the same thing. We're going to talk about buying a put. So here, if let's say we buy a $100 put on the stock XYZ, so a stock XYZ at 100, I'm bearish on it, so I think it'll go down to 95 or 90 or however lower I think it'll go. So if you're a simple options trader, you could look at buying a put option, so buying a $100 put let's say that costs you $4. Same thing, you have a max loss if the stock goes to $100 or higher. So if you're wrong on this, and your break-even price now is $96 or lower because you've paid $4 for that put, the stock needs to move $4 or more in order for your strategy to be profitable. So on a long put vertical, it's the same thing. What we're still doing is we're still buying that $100 put for $4, but now what we're going to do is we're going to sell, let's say, a lower put, a $90 put for, same thing, a $1 credit. And what that brings in is a $1 credit. So our max risk now is $3 instead of $4. And same thing, what we're giving up is upside in exchange for max reward. So this strategy will be profitable as long as the stock is $90 or lower. I'm sorry, $97 or lower. That's your break-even price. You will get your max profit of $7 if the stock goes to $90 or lower, and you will lose the $3 if the stock is at $100 or higher. So this is really how you can go about thinking about debit spreads, is that what type of returns are you trading off in exchange for fairly limited risk? And again, because most of the time you have when you're trading these debit spreads that are maybe 1-2 months out, there's only so far you think the stock will go. So there's no need to pay for that unlimited upside. You should try to sell an out of the money call or put against that long call or put, and that's going to help offset your risk. And that's really the key of why debit spreads is a more efficient directional exposure for a defined move with a target price. So again, what we want to do is we'll go through a few examples here today with some real stocks to really solidify this aspect of trading debit spreads. So the strategy itself, now that we've defined how to construct a debit spread, I want to talk a little bit about when you should utilize it. So number one, debit spreads are really for when you're expecting a large bullish or bearish move. So with the stock, with buying a call or a put, you need a decent sized move before the strategy is profitable. The debit spread doesn't change that too much. You still need to have a decent sized move before the strategy is profitable. So this typically is useful for breakouts or breakdowns when a stock breaks above a certain resistance level or breaks below a support level, or maybe bounces off a support or resistance level where you have a clear target price. These are also useful and sometimes in strong momentum stocks that can move a lot, are really useful for debit spreads. And lastly, if you do expect a more modest or neutral move, that's really when a debit spread is not an ideal strategy to utilize. So again, when you're setting up your trades, I'll give you some charts in a few minutes to illustrate this, but whenever you're setting up your charts or you're setting up your trades and you're thinking about how big of a move am I expecting to come out of this, that is really one of the decisions to decide whether a debit spread is suitable for you or not. Now, if you expect more of a modest or neutral move, then you might want to sell credit spreads. That's what we're going to cover in our webinar next Thursday. So I hope to see you guys there for those of you that are interested in trading credit spread. So let's talk about what are the benefits of debit spreads versus just outright buying a long call or a put, because the way that you should really think about debit spreads, it's really graduating buying a call or a put into slightly more advanced strategy, because what it does is it lowers your total risk. So in the examples before, instead of buying a call or a put for $4, I'm now getting the same directional exposure for only $3. So I've limited my risk by 33%. And what that does is it really magnifies my returns when I am correct on the trade, but minimizes my risk when I'm wrong on that trade. And that's really the key to more profitable trading. Is you can be more profitable by finding better trades, but you can also be more profitable by simply just limiting your risk. And that's really one of the key reasons why debit spreads is one of the more efficient ways to deploy your capital. By limiting your risk, you're also creating a better break-even price. The stock does not need to move as much in order for your strategy to be profitable compared to outright buying a call or a put. And lastly, whenever you're buying any options, time decay is really always working against you whenever you're buying options. One of the better ways to offset some of that is to have one short leg, because now you have a short leg where time decay is working in your favor, so that you're not as time sensitive to timing when you're trading a debit spread versus if you're just outright buying a call or a put. because if you just buy a call or a put, you always have that erosion working against you. So you have to time your trades relatively fairly sensitively. When you're buying debit spreads, you don't have to be as time sensitive. You should still be aware of it, but you don't have to be as time sensitive. So those are some of the benefits and when you should consider using debit spreads. So next, what I want to talk about is what do we find are the optimal debit spreads? What type of expiration dates, what type of strike prices? Now, with respect to expiration dates, this really follows relatively the same rule of thumb as buying calls or puts, in the sense that because you're net long options when you're buying a debit spread, you want to minimize time decay. One of the best ways to do that is by buying a slightly further out of the money, a further dated option. So anywhere from 5 to 8 weeks out is usually the minimum threshold of when you should be, of the options that you should be looking at when you're buying any form of options. Even if you're just buying a call or a put, you generally want to go out at least 5 to 8 weeks in that time area to buy options. Even if you only plan on holding onto the trade for a week or two, you should still buy a longer dated option because it's going to erode much slower than buying, let's say, a 2-week option. As far as the strikes, we've backtested these strikes across pretty much all different deltas, different percentages, and it's pretty clear that the optimal debit spread is where the long leg is just slightly in the money call, so 50 to 60 delta call or a put. Usually the first or second strike that's in the money is usually a good starting point, and then selling about a 10 to 15 delta call or a put against that. So a call that has roughly only about a 10 to 15% chance of being in the money is where you want to sell. You want to sell relatively far away. And the reason we use delta is because we want to adjust for when volatility changes, because if a stock is about to report earnings and volatility is very high, it's naturally going to select a call or put that's further away because delta automatically adjusts for increases or decreases in volatility. And when things are quiet, it'll automatically select a call or a put that's a little closer to the current price because volatility is lower. So this is really why we always use delta to choose our strikes, regardless of what strategy we use. And lastly, once you use this type of setup, so where you're buying about a month and a half, 2 month out option, where you're buying a 50 to 60 delta call or put and selling a 10 to 15 delta put against that, what you're generally going to find is that the premium of the short leg, meaning the amount of money that you're going to receive by selling that 10 to 15 delta call or put, will roughly be around 10 to 20% of the long leg. So if you were just outright buying a call or a put, you're usually going to save about 10 to 20% of risk by trading a vertical versus outright buying that call or put. And generally what you're going to find is that you're going to see a relatively higher probability of profit for a debit spread, usually 33 to 40% winners in this particular case in terms of probability of profit. And then you will usually see a decent risk to reward where you're risking somewhere between $100 to try to make roughly $200 to $250 in reward on the trade. So you're always risking less to make more on this specific type of trade. So lastly, what I want to show you is, for those of you that use charts, one of the main characteristics of trading debit spreads is the fact that debit spreads is something that you have to be relatively patient on, because it's not every day that you come across a stock where you say, hey, I think this stock's about to make a big move. Where this could be a technical setup, this could be a fundamental setup, this could be a statistical setup, whatever type of signals you like to use for your trading. It's not often that you find trades where you think that it's going to make a big move, versus there may be very often where you find the stock's going to trade in a relatively tight range or not move a lot. So when we're trading debit spreads, as you can see on this particular chart, there's only one area of which I do think that there was the possibility of making a big move. So when this broke above that triangle, we expected a big move, and that's exactly what we saw here. There was a bit of a fake out here where it kind of broke above a resistance level, And you could have been caught in that thinking that this was going to rally significantly higher, but it didn't. It reversed right back into that. So, when you're trading credit spreads, you might trade the same stock over and over again. When you're trading debit spreads, you tend to really trade all different stocks all the time because, again, it's not every single day that you're going to find a stock that you follow, you think that it's going to make a big move. So that's one of the key differences between trading debit spreads versus trading credit spreads, which is what we're going to cover next week. So how do you actually manage these trades? So one of the reasons why I like trading debit spreads is because the management of these trades are really simple. The rules apply regardless what type of trades that you make, whether you traded a debit spread exactly the way we optimize it for, or if you trade your own strikes and own expiration dates. The rules are generally all the same. So you want to time your entries with when you expect a large move. So again, this could be a technical setup. This could be a technical indicator that gives you a buy or sell signal. Whatever that signal is, you want to time it when you actually expect a move to happen. You want to time it correctly. Once you're in the trade, this is really where it's relatively easy because you're placing a trade based on a move that you're expecting in the underlying stock. So when you cut your losses or when you take profit is really dependent on whether that stock makes the move that you're expecting or not. And the goal here is to simply cut your losses if the move that you're expecting doesn't materialize. So in my first example, in stock XYZ that's trading at $100, if I'm bullish on it and 3 weeks later, the stock's still at 100, 101, and the move that I'm expecting just doesn't quite materialize, then you need to cut your losses regardless of where you are at that particular phase. Meaning, if the move that you're expecting doesn't happen, cut your losses, move on. Now, with debit spreads, or with buying any options, the general rule of thumb is that you always want to exit the trade before expiration. Unlike selling options where you want to hold it to expiration, when you're buying options, you want to sell it before expiration. So the rule of thumb here is that if it doesn't really hit your target price or if it doesn't materialize and the stock hasn't moved enough, you generally want to cut your losses where you've lost anywhere from 50% of the price that you've paid for that vertical spread. So in the example in stock XYZ, if I paid $3 for that vertical spread, if it goes down to $1.50, it's time to cut your losses. On the flip side, if you are correct on the trade and you're seeing gains of anywhere from 75 to 100%, that's when it is time to start taking at least partial profits. What that means is that if you're trading 1 or 2 contracts, you should take all the profits. If you're trading 3, 4, 5 contracts or more, you might at least want to take profit on a couple of those contracts and maybe leave a few more on if you think that it's going to continue making moves. But regardless, you want to make sure that you have rules on both the downside and the upside to decide when it's time to take profits. Now, I get some questions about adjusting these strategies. Now, I'm really not a big fan of adjusting these strategies from the perspective of the question you should ask yourself when you're about to make an adjustment is, would I make this second trade if I wasn't already in a losing trade? And 9 out of 10 times the answer is probably no. And that's really why I find adjustments usually you're just trying to make back money that you've already lost. And that's never a good proposition to add on more risk to something that you've already factored into in terms of risk. So if you find yourself in the position where you would have made a trade regardless of the fact that you're already in a losing trades, then that is really the only time you want to make an adjustment. And making an adjustment really just means closing out your current trade and placing a brand new trade. Regardless of how much you've lost or what the strikes that you currently have really have nothing to do with what strikes and expirations you're going to choose the next time. You should choose your strikes and expirations based on the same principles that you chose your first expiration on. So if, let's say, you buy at that 100 by 110 call spread that I just gave you in that first example here, and the stock doesn't really move, but it moves up to like 102, then you might just want to buy a 102, 112 call option at that point. The same rules apply in terms of making adjustment. You're just simply closing your initial trade and opening up a new trade as if the old trade didn't exist. That's the best way to think about an adjustment if you do find yourself in that particular case. And lastly, I do get a lot of questions about implied volatility and trading debit spreads when implied volatility is high or low. And what I want to do is I want to jump over to some real examples here, and I think that's going to help me better illustrate as to why implied volatility, while important, should not be a critical factor in determining whether you want to trade a debit versus credit spreads. So right now what I want to do is I want to jump over to options play. I want to show you some real examples, and what I want to do is I want to open this up for a lightning round to allow you guys to submit symbols and whether you're bullish and bearish on those symbols, and for us all to take a look and show you how quickly you can utilize this tool to analyze a trade very, very quickly. So I'm going to first start off with a couple examples of my own, and then please, you guys can type in your symbol, but please put a bearish or bullish on top of that so I know what your views are on that stock in order for me to analyze that. So let's take a look at Apple real quick. So this is a stock that, you know, really had a strong rally, but recently broke out above that 200 support level, is starting to continue to make highs. So I do think that this thing could probably make a run at least to about 210, if not 215 or so, considering it's got earnings coming up in a few days. You know, that could be one way or another. I don't particularly have a strong opinion, but there's certainly momentum and strength behind this particular stock right now. So the platform itself, Options Play, is divided into three sections. You have trade ideas, watch list, and portfolio on the left. In the middle is your security analysis panel. And on the right-hand side is trading and income. So the three panels are designed to help you automate your whole workflow of options trading. So every morning you have fresh trade ideas, a watch list that are pre-built for you with stocks that you want to watch, as well as a portfolio to help keep track of our daily play ideas. Our middle panel is our security analysis panel. We do have separate webinars just on showing you how powerful the middle panel is and giving you a sense for directional views. But we have a 1 month and 6 month trend indicator, a technical score to give you a sense for relative strength, and things like earnings, dividends, and price action data here at the bottom to show you relevant information that's necessary for options trading. So once you have that view on the underlying stock, you can either select I'm bullish and show you 3 bullish strategies, or select I'm bearish and show you 3 bearish strategies. So for now, we're going to look at some bullish strategies on Apple. And we're always going to show you buying a stock, buying a call option, which is that simple strategy that we talked about, and then buying a vertical debit spread. This is the strategy that we're here to explore here today. So buying 100 shares of Apple costs you $20,000. Buying a single call option only costs you $755. But as you can see here, buying that 202.5 call, which is the at the money call, cost me $755. Here on the vertical, what I'm doing is I'm buying the 202.5 call, but automatically I'm going to sell the 220 call against that, because the 220 call is a call that has roughly about a 15% chance of hitting that price or higher. So relatively small price. And notice how I'm able to reduce my cost basis from $755 down to $603. So I'm saving about $150 on that specific trade. And this is really what you're going to be able to see. So if the stock rallies up to, let's say, 215 or so, as you can see on the stock, I make a 5% return. On the call option, I make a 65% return. On the call spread, I make a 107% return. So notice how that $150 discount that I'm getting on the vertical spread versus buying that call option changes my return significantly from 65% return to 107% return. And if this goes even further, it gets magnified even more. So at 220, I do make a very nice 131% return on the call option, but I make 190% return on the call spread. And that's really why the benefit of trading call spreads versus outright buying that call is going to give you in terms of boosted return if you are correct, and vice versa if the stock declines back up to, let's say, 180 on a poor earnings. If, let's say, they miss on earnings and they fall back to 180, if you had bought 100 shares of that stock, you'd lose $2,300. If you bought a call option, you would lose $755. If you bought this call spread, you lose only $603, a fraction of what you risk in the other two. So that's why, again, why we consider this strategy, the debit spread, the most efficient strategy to take a directional view, because if you're right on the trade, you get a much higher return. And if you're wrong on the trade, you actually risk the least amount of money. That's why this strategy here on the right has the higher options play score. We've crunched the numbers and we tell you that this strategy here on the right will give you a better risk to reward in pretty much all scenarios. So we're accounting for potential losses and potential gains when we're calculating that score. And that's really how we go about instantly showing you how easy it is to use this platform to quickly find potential setups, regardless of whether you're a brand new options trader and you've never traded an option before and you're only familiar with the stock option, buying the stock, or if you're relatively new and you're starting out and you're buying calls and puts to familiarize with this strategy, and then eventually graduate yourself to that trading call spreads, because again, it lowers your risk and boosts your return when you are correct in your directional view. So as you can see, that was just a quick view on Apple. Why don't I start pulling some names from the chat window already? So again, if you have some names that you want me to take a look at, please type the symbol and whether you're bullish and bearish on that specific name, and we'll take a look at some ideas. So Christopher said ETN, and he's bearish on this particular trade. So I'm going to right off the bat, say that the technicals on this stock is very strong. It's got strong relative strength. 1 month and 6 month trends are bullish. Maybe you feel that this is a little overdone, so you're bearish. So let's click on I'm bearish here. So Eaton is at 85. So what we're doing is we can short 100 shares of the stock, or we can buy a put option. A put option costs us about $280, which is actually fairly expensive. And that's why we see a relatively low options play score versus buying that same 85.5 put, but then selling a 79.5 put against that. That reduces our cost basis from 280 down to 225. So let's take a look at this. Now, if this stock was to be bearish, I certainly would expect that this would pull back to probably around at least $80 or so to the downside. And this stock does report earnings in 12 days, so that certainly could be a catalyst for that. So let's say the stock declines to $80, even if it does it in a relatively short amount of time. As you can see, I'm looking at about 100% return, 103% return on these two strategies if the stock does pull back, and vice versa if the stock keeps rallying. If the stock goes back up to that 89 52-week high, then as you can see here, if I shorted the stock, I'd lose $430. I'd lose $254 if I bought the put. I'd lose only $199 if I bought the put spread. So again, that's why we want to utilize these types of strategies to limit our risk as much as possible, because when we do that, it really maximizes our return when we are correct. And to be successful in trading, it's really more important to manage your risk. So let's go through a few more examples here. So Facebook, Matt says he's bullish on Facebook. Facebook recently just broke above that 175 resistance level. So let's take a look at that. 100 shares, 17 grand. Buying an at-the-money call option, $800. Buying that at-the-money call option, but then selling a 197.5 call against that, brings that cost basis down to $655. So again, we're saving here around another $150, which, as you can see, if this stock rallies back up to, let's just say there's a modest rally. Let's say it goes up to 190. This stock reports earnings in 6 days, so that certainly could be a potential catalyst for that. As you can see, if the stock rallies up to 190, you have a 57% return on the call, a 90% return on the call spread. So if I was looking at this, I would say that this is not attractive enough, because I'm only looking at a 57% return if I do get this bump up to 188. Granted, it's not a big bump, but if I do get that, it's only looking at a 57% return versus here, I have a 90% return. That's much more in my wheelhouse of what I'm looking for in terms of minimum return for me to take on this risk, because there's always the risk that this stock declines and I lose my $655. So in order for me to make it worth my while, I need to see roughly at least about a 600% return if I am correct on the trade. So those are the types of numbers that you should be looking for. Lauren's asking for CGC, and he's bearish on CGC. So Canopy Growth, this looks like a bit of a triangle here with some support around $40. Let's say I'm bearish on CGC trading at $44. So I can short the stock, buy a at-the-money put option for $405, buy that 45 put option, but then sell a $36 put against it, bring it down to $355, saving myself about $50 or so. And let's see how that works out. So, in this particular case, if this stock does crack below 40, I think you get a very quick return back to about that $30 level. Granted, that's a bit of an extended play, but if that does happen, as you can see here, the put option certainly looks very attractive here because a put is able to take unlimited gains to the downside. So you do get a 268% return. The put vertical, because you've sold that $36 put, you've capped your gains. So now you only get 153% return for the $355 that you risk. So this really, you have to ask yourself, how bearish are you on canopy growth? So if you think it's only going to go down to $36, then you certainly may want to consider buying that put spread. But if you do think that you're going to get a move down to 30, this is really where, buying that put option is going to be probably better off for you in this particular case. So this is how you can utilize our tool. Type in any symbol, click on either I'm bullish and I'm bearish, and using our P&L simulator within a few clicks, get a pretty good sense for which strategy is best for you and what type of returns you should be looking for. Steven's bullish on Micron, so let's take a look at Micron. Micron's just flirting with this 43-44 resistance level. It's got relatively strong technical scores. 1 month and 6 month trends are bullish. So let's say for argument's sake, this stock does break above that resistance level and maybe makes a run at maybe 46, possibly 53. 53 is probably a bit of a stretch, but maybe 47 or so. So let's take a look at Micron here. So 100 shares is $4,300. At the money call option is $250. Buying that call spread brings your cost basis down to about $220 or so by selling that $49 call against it. So what did we say that we thought that it was going to go up to about 47 or so? So if the stock rallies up to 47, 8% return on the stock, 59% return on the call, 81% return on the call spread. So now you have to ask yourself, how bullish are you on Micron? From what I can tell here, I certainly think 46, 47 is a reasonable target price. You do have some maybe support around 50. So if it does rally up to 50, this does look very interesting, obviously, but I'm not sure how bullish you are. So that's a question for yourself. If you're mildly bullish, I would say this is okay. If you are more bullish, then this certainly may be more attractive. But if you're only mildly bullish, maybe there might be other strategies for you in this particular case, because 81% return, while not bad, is certainly not what I would consider a really good return. John is saying bullish on Google, or Alphabet rather. Keep forgetting that. So Alphabet's trading at $12.41. This stock certainly looks like it's about to make a breakout. It certainly has broken above that $12.36 high from before. Do I think this will make a run back up to $12.90? That certainly is possible. It's got strong relative strength. 1 month and 6 month trends are bullish. 100 shares of that stock, $124,000. Not a lot of people have that kind of money to buy a round lot. So buying a call option costs you only $4,000. So a small fraction of the cost. So about 3% of the underlying cost gives you the same control as buying 100 shares of that stock. And what you can do is you can gain further same type of exposure for even another reduction of about close to $750 by selling that 1330 call against it. So buying an at-the-money call, the 1240 call, selling the 1330 call against it brings your cost basis down to $32.60. So we said that we think the stock can make a rally back to that 52-week high around $12.90. As you can see here, 3% return on the stock, 23% return on the call, 53% return on the call spread. Not what I would consider super attractive. So in this particular case, I personally would probably pass on this specific trade, unless you really thought this stock was somehow going to blow through earnings and get up to that 1330 level. It just doesn't quite look like a very attractive trade from my opinion. I might be maybe better off consider selling a credit spread in this particular case. So that's my thoughts on Google. Let's look at Amazon. Let's Kel is bullish on Amazon. Amazon also similar type setup, major resistance level around 1850, just broke above it. Just broke above that 1850, 1860 support level. There's not much in its way all the way up to about 1250 or so. So you might be on the verge of maybe a big breakout here on Amazon. You might even want to buy yourself a little bit more time on here. Maybe you might want to go out to June. And what you can do is you can always use this tool to help you figure out where to sell that upper bound on the call if you change your expiration date, because all of our strike prices have the standard deviation marks on it. So you can always sell that one standard deviation call, buy the 1860 call, sell the 2045 call for the June option. So as you can see, I can buy myself roughly an extra month or so, or an extra 20 days or so for the same, for actually less price than buying a May at the money call. And May at the money call cost me $6,600. Buying a June debit spread only cost me $6,300. So this is another way that you can think about using debit spreads, is to simply buy yourself more time compared to outright buying that call option. So here, we said that what if it makes a move to about 1250 or 2050? Here, 192% return. That's the type of returns that I would really like to see from these types of strategies, to risk $6,000 to potentially make $12,000. And worst case scenario, when I'm wrong, if the stock declines back to that $1,600 level, which is where it was for a long time last year, here I'm only risking $6,000 as opposed to $26,000 if I had bought the stock. And this is really one of the benefits of trading debit spread. So I have a few more minutes. I'll try to get to as many examples as possible. GD is bullish on FedEx. Again, this stock is one of those stocks. I think it's a little bit late because the stock recently broke out above that 178 level, but I certainly do think that there's probably some level of push that you can get to maybe around that 200 to 10 level or so. So 100 shares of that stock, $19,000. Call option, $685. Call spread, $632. Not a significant amount of savings here. So selling that 212 call is really saving you only about $50, so less than 10%. So as you can see, the difference between these two strategies, not that big of a difference here. So like I said, if I think it's going to go up to 210, 5% return on the stock, 82% return on the call, 97% return on the call spread. So this call option is pretty expensive, and you're not getting much juice on that selling that 212 call option. So this strategy does provide a small boost, but not as big of a boost as some of the other strategies. Kel is bearish on TLT. TLT is at 122, recently just broke below that major 123 support level. Do I think this could get a pullback maybe around to 119? That's what I would probably target here. So shorting 100 shares of that stock, buying a put option costs you $140. Buying that put spread, 107. So you're reducing that by about $30, which is a significant a percentage that you're saving. So as you can see, the stock pulls back to that 119.5 or so support level. Shorting the stock gets you a 2.5% return. Buying a put option, a really nice 150% return. A put spread, 180% return, making $193 profit by risking $107. And in your worst case scenario, if TLT rallies back up to 126, your risk is limited to $107 a share, as opposed to a significantly more on buying the put or shorting that trade. Samuel is bullish on MGM. We also are bullish on MGM at this particular time. It certainly has formed a bit of a inverted head and shoulders here at the bottom, and I do believe that this has some legs to rally back up to maybe about that $29, $30 level or so. So 100 shares of that stock, $2,700. Buying a call option, $132. Buying that call spread by selling that 30.5 call. We're reducing that from 132 to 118. Not a huge amount of savings, but I would still say it's significant. So that stock rallies up to that $30 or so. Buying that stock, nice 9% return. Buying the call, 89% return. Buying that spread, 111% return. So getting $132 profit risking $118. I have time for maybe just a couple of more. Netflix, bullish. Mike is bullish on Netflix. So Netflix here trading in a pretty tight range for the last few weeks or so, between 340 and 370 or so. And if you're bullish on this, you would simply want to see a significant breakout above that 375 level. I don't know how far it can go. There seems to be quite a bit of resistance around 385 or so. Maybe you get an extended move up to 405, but let's say 385 or so is your profit target. So first of all, I have to switch to I'm bullish because Mike is bullish on Netflix. $36,000 to buy 100 shares. Call option 1,500. Call spread 1230. So if I do get that move up to about 385 or so. Oh, that's not bad. 7% return on the stock, 61% return, 103%. So I do make 1270 off of a risk of 1230. So those are the types of returns that even if you get a modest move up to 380, you do get a pretty nice return. And worst case scenario, if the stock drops to 335 towards that lower end of the range, you're risking about 1230 or so. So you're making one-to-one, particularly on this particular trade. I have time for one more. Thank you so much for all your contributions, but I'll try to get to as many as I have time for. PayPal here is now at 107. I believe it'll be over 140 in 3 months or so. So this certainly has been one of those stocks that has just really ripped since the lows of last year. So you think it'll go up to 140 or so. So first of all, to get that kind of move, you might want to look at a longer dated option, maybe June, maybe even further dated, maybe July. Let's see. So let's take a look. I'm not sure this will work out. Looks like things are pretty expensive, but if you do get that move to 140, you are seeing a significant rally in this particular stock. So you do get a crazy return. But like I said, 140 is a very, very aggressive target, I would say, considering the stock was at $75 just a few months ago. To think that this will effectively double in the next few months is ambitious, I would say, at the least. But if you are that bullish, you certainly can use this tool to help you better understand what is the correct strategy to use. Last one, Raymond is bullish on HON, Honeywell. Honeywell is certainly one of the stronger stocks, and looks like it's just recently breaking out above that 165 level or so. I don't know how much upside there is left in the stock. The 52-week high is around 160. This stock must have reported earnings. It looks like after hours is up 169 already. So it looks like this stock has rallied above that 52-week high already. So maybe you think the stock's going to continue rallying to 167, maybe even higher. So depending on your target here, maybe you think it'll go to 180 or so. As you can see, if you do think that this can make a run at 180, maybe that's too crazy. Maybe 176, 3% return on the stock, 84% return on the call, 100% return on the call spread. So I know I went through a lot of examples here today, but that was really the goal here, was to show you how easy it is to use this platform to simply type in a symbol, either select I'm bullish or I'm bearish, and instantly be able to start playing around with these types of strategies. Start using the P&L simulator to see, well, if the outlook that I have on the stock plays out, how much do I make? More importantly, if I'm wrong, how much do I lose? Am I comfortable with that type of risk to reward? And try to scan for opportunities where you're at least getting the amount that you're risking when you are correct on that trade is the type of trades that you'll be looking out for. So I want to thank everyone for taking the time out here this afternoon. What I want to do is provide an opportunity for users to ask any questions. So if you have any questions regarding anything I just explained here today about debit spreads, please type them into the chat window and I'll try to answer as many questions as I have time for. I hope that through using this lightning round and taking suggestions from you guys, you're able to see how you can utilize this tool on your own research, because that's really the goal here, right? Is not necessarily just to teach you what a debit spread is, but make sure that you have the tools to be self-sufficient in being able to analyze these strategies and deploy them yourself. So if you are relatively new to options trading, I highly recommend taking a look at our recording, because that's going to allow you to see how we utilize this platform, go through as many examples as possible to really show you how to use this tool as efficiently as possible. So with that, what I'll do is I'll look at the questions that I have here and try to answer as many as I have time for. So I think I've talked about adjusting trades, talk about how to use debit spreads combined with earnings. I think a lot of the examples that I showed you have earnings built into it. You say you don't factor in IV because delta adjusts for it. So when do you consider IV? So generally speaking, I don't consider IV because implied volatility has a relatively low impact on your returns. So as you can see, if the implied volatility of Honeywell right now is at 15%, even a 50% increase in volatility to, let's say, 22.5 is what I would consider an astronomical move in implied volatility. My losses, or let's say gains, instead for 1 second, my gains go from 432 to 375. So it's a difference of $50 or so in what I would consider an astronomical implied volatility move, versus the stock only has to move about $1 or so for me to risk that same $50 or so. So you have much more exposure to delta than you do to time decay, or to volatility rather, which is why you should be far more focused on where do I think the stock will go, how far do I think it will go, because that's really what's driving your profit or losses on your trade. Changes in implied volatility will have minor changes. So even if you expect volatility to decrease by a significant portion, the changes in your P&L is very small. And again, that's why we don't utilize IV as much in our trading. It certainly has a factor in your trading, but it's not as big of an impact as some places make it seem. So keep that in mind. And the only way to tell is by utilizing tools like this that will actually show you, hey, if you felt that IV is really high and you sold a credit spread, don't just take that don't just take that at face value. Put a credit spread next to the debit spread, put in your outlooks and see which strategy gives you a higher return. That's going to tell you whether you should trade the debit or credit spread. Don't just go off of the fact that IV is high or IV is low. Roger's saying, could you remind me what are the variables that you factor in to determine the options play score? Really good question. The two things that we look at is the risk to reward ratio and the probability of profit. So this is really thinking like a poker player's mentality, meaning what is my probability of winning this pot, and what is my gains if I win, and what are my losses if I lose this pot? And you can think of trading the same way you think of a poker hand. And what we're really calculating is our odds, and that's what the options play score is looking at, is what is the risk to reward if we're right or versus wrong, and what is the probability of actually being right versus wrong. And that's how we calculate our options play score. John is saying, why not sell a put spread and collect more money up front versus buying a call spread? John, selling a put spread is a completely different strategy. So I'm not sure that that is a right approach to even consider thinking about it, because selling a put spread is a neutral strategy. So if I sold a put spread like this one, and maybe I'll make this a little prettier, so it's an actual put spread that I might actually trade. So if I sold this put spread, let's say I'm willing to risk $1,000 on these trades. If I sold the put spread and I'm bullish on Honeywell, and Honeywell goes up to, let's say, that 176 profit that I'm looking for, here, as you can see, for the same $1,000 roughly, or maybe I have to make this a bit more. Let's say I'm willing to risk $2,500. So here I'm risking $2,100. Here I'm risking $2,100. This is the put spread you're talking about. Here's the call spread that I'm talking about. If I do get this rally that I'm expecting up to 176, if I'm risking $2,100, if I bought the debit spread, I make a $1,600 return. If I sold the credit spread, I make about half of that. That's why you don't want to compare a put spread to a call spread, because they're really not comparable at all. One strategy is to make money when the stock doesn't move. Another strategy is for when you do expect a move. So that's why we don't compare selling a put spread to a debit spread. Now, if you're interested in selling put spreads, please come to our webinar next week, which we're going to explain what a put spread is, what selling a put spread means, and when you should actually be utilizing that strategy. Bob is asking, OI and volume are very low. Is it okay? So you have to look at the options, the open interest and the volume of the whole chain. You can't just look at the one option that you're trading. So sometimes a much better gauge for liquidity is the spread between the bid and the ask price. So here, $3.06 by $4.23, that's a massive spread. That's why on our spread of liquidity, we're telling you that this is not very liquid. So we use the bid-ask spread, which is usually a much better gauge for liquidity than open interest and volume. What about analyzing IV on those trades? So I think I just talked a little bit about analyzing IV. You certainly can analyze our IV, but as you can see, the impact typically to your returns is fairly minimal, even with an astronomical change in IV. What are your rating scales? I'm not sure which ratings you're referring to, Tapas. If you can clarify, I'm happy to answer that question. Could you utilize a vertical put in this case? Not sure which case you're referring to. S. Wells, if you could clarify, I'm happy to answer that question. Won't the volatility drop after earnings event and projections may vary? Yeah, absolutely. So this is one of the things that we covered in our earnings webinar last week for those of you that attended. So for example, on a stock like, let's say Apple, on a stock like Apple that reports earnings on April 30th. So we do expect that after earnings, so let's say on, I don't know, May 10th, if we do get this move that we're expecting, volatility does come down after earnings. So that's one of the ways that you can adjust for that decrease in volatility, and you can get a slightly more accurate return profile. But like I said, the difference between 1146 and 1124 in a relatively decent size move, so from 24 down to 20, which is a pretty big move in volatility, you're looking at about a $20–25 difference in terms of P&L. So again, this is why for those of you that spend a lot of time looking at IV, don't go crazy, because the impact to your actual bottom line is relatively small from changes in volatility. Wanted to ask if options play allow me to use both US and Canadian markets. Yes, we do have a Canadian version of options play. You can sign up at optionsplay.com/TMX. I'll just send a link in the chat window. What should be my expiry date? So like I said, we always start off by roughly about 45 days to expiration. That's always our default starting point. We think that's usually a good starting point for most people to use, is about a month and a half out. Why the green check mark or the options play logo sometimes? So the green check mark just tells you which strategy has the highest options play score. It's simply that. And occasionally when you hit the trade button, if all 5 things are green, that's when you get an options play logo, just basically saying that everything that's on the strategy checklist checks out, on top of the fact that it's the highest options play score. How long was this back test? What's your average win rate? So the win rate is dependent on your signals. It's not dependent on the strategy itself. So depending on how good your signals are, that determines the win rate. But we back tested the vertical spread for the last 10 years or so with our signals, and these are the types of strikes and expirations that give you the highest types of returns for our specific type signals. But most signals are, I would say, in line with the type of signals that we're looking for, which are purely determined by technical indicators. What are the circled numbers? That's the options play score. That's something I just covered here today. Does your tool show ex-dividend date? Yes, it shows ex-dividend date here at the bottom when there is a ex-dividend date coming up. How do you get the recording? Great question. So you can sign up for a free trial here at through this link, which as long as you're registered for these webinars, which you obviously are if you're on this webinar, you will immediately receive the recording after we finish our webinar. So that will actually get emailed out to you. Can you discuss the pricing of closing out before expiration? So I'm not sure what you mean by pricing, because if, let's say, you buy this this call vertical spread for $612, wherever you were about to close it, it'll be worth some amount of money in the future. So maybe this is worth $1,000 in the future, so that you would sell it at $1,000 and realize the difference between $1,000 and the $612 that you bought it for. So I'm not sure what you mean by the pricing around closing. How do I get to ideas? John, I'm not sure what you mean by that. If you could clarify, I'm happy to answer that question. How do you find stocks that are experiencing high options activity? So there's lots of scanners out there that do this. I'll be honest with you, I'm not sure what high options activity really tells you. There are plenty of people that follow it, but I don't know what you'll necessarily get out of that per se. Just because other people are trading it doesn't necessarily mean that there's going to be a big move, or chances are perhaps the big move may have already happened. But if you really want to scan for high options activity, you can simply Google it. There's lots of scanners out there. Some are free, some you have to pay for, that provide that type of information. If the prices go in my favor, let's say in a 3-month expiry, when is the best time to sell before time decay really affects my gains? So again, going back to this rule, you want to cut your losses at 50%. You want to take profits when you reach 75 to 100% gain, regardless of whether it takes a day, a month, or 3 months to get there. These are the types of rules that you should be following when you're trading debit spreads. Have you recorded a previous credit spread strategy on the inverse strategy? Yes, we have. So that is on our YouTube channel if you want to view our credit spread trading strategy there. But it is something that I plan on doing next week. TAPAS 95 115. I'm not sure what that means. If you could clarify, happy to answer that. It was the Google example. Okay. Let's see. How important is it to consider the probabilities? It's generally around 38 to 40. So the probability of profit on debit spreads really doesn't matter that much, because you're not holding it to expiration. So probability of profit is really only a useful indicator if you plan on holding it to expiration. So if you're selling credit spreads, if you're selling calls, if you're selling puts, probability of profit is much more important indicator. When you're buying debit spreads, because you never intend on really holding it to expiration, the number doesn't mean as much. So your win rate is really contingent upon how good your signals are. It really doesn't have as much to do with the credit spread, the debit spreads themselves. Can you please explain how probability of profit is calculated? Sure. So probability of profit is simply looking at the break-even price of each strategy. So if, let's say, I'm buying this call option, my break-even price on that is 210.10. So the stock needs to move up to 210.10 by expiration date before the strategy is profitable. So the probability of profit is really looking at what is the probability of Apple stock being above 210 at expiration, and that number is 34%. That's calculated using the implied volatility of the option right now. Is there a way to backtest a strategy using your platform? So unfortunately, there isn't. Backtesting, especially with options, is an extremely not only computationally heavy, but there's a lot of parameters that you need to set up that I just simply wouldn't expect someone to be able to do without doing a lot of programming on your own, which is why this is not something that you typically see. There are a few option backtesters out there, but it does require a heavy amount of setup, I would say, in order to backtest any specific strategy. And it doesn't really account for the fact that, it doesn't know when you want to buy or sell. So there isn't really a good way to backtest option strategies, I'll be honest, unless you're willing to code your own, which is really what we've had to do on our own. We had a team of quantitative analysts to build out software to figure out when to trade, what to trade, and how to calculate P&L. It is a very involved process, unfortunately, which is why it's not very common that you see options backtesting software. Is the market delayed by 20 minutes? Yes, it is delayed by 20 minutes. We did just switch to a new market data provider, so we are expecting to be able to provide real-time prices, at least in the US, on equities and options. So that is something that we are expecting to have in the next 2 to 3 months. Bob, good questions on OI. Great. Raymond, thank you so much. I really appreciate it, and thank you for participating every single week. Jesus, instead of 5 to week expirations, can I look for only 1 to 2 week expirations when I expect a big move? You absolutely can, but I think you're going to find that you're going to lose money a lot of that time, because in that last 1 or 2 weeks, you have a lot of time decay and you have a lot to fight against you to do that. So let's say instead I change this to a 2 week option. So let's say I buy a 205, let's say a 202.5, 215 or so. So now, instead of this stock having to move to 210 in the next 43 days, this stock now has to move to 207 in just 15 days. So I need 2/3 of the move in 1/3 of the amount of time. So this is really why this strategy is not you can certainly do it, but you're fighting an uphill battle every single time. So as you can see here, I need about a $4 move in 15 days versus here I need about a $7 move in 43 days. What do you think is more likely? I think a $7 move in 43 days is much more likely than a $4 move in 15 days. So again, this is why you always want to go further out in time. You're not saving much money here. You're only going from 760 down to 480, and you're fighting a substantially harder uphill battle when you're buying this 1 to 2 month options. Tapas, thank you. How are your trade ideas collected? Our trade ideas are scanned based on technical indicators. These are pretty standard technical indicators that our trade ideas are generated from. So if you click on any trade idea, you'll see which technical indicator it was generated by. So here it was CCI. That was the indicator that generated the sell signal on this particular trade. Here it was also CCI that generated this trade. So you can actually click on a trade idea and see which technical indicator generated that trade idea. Is there a video on best ways to use a trade ideas section? So yeah, we have a separate video on finding your directional view or directional trend using options play. It's in our YouTube channel. I'll send you the link to take a look at to our YouTube channel in the chat window. That you can use. You can see all of our previously recorded webinars there. Does that just apply to debit spreads in terms of further out in time? No. So again, debit spreads. Any strategy where you're buying options, that's when you want to go further out in time. If you're selling options, so the strategy we're going to cover next week, credit spreads, that's when you want to go shorter in time, because shorter, you're going to get higher time decay, and that's what you want when you're short options. So when you're short options, you want to be on the short end of the curve. When you're long options, you want to be on the long end of the curve. Roger, I'm renewing for another year tomorrow. I learned a huge amount over the last year. Thank you so much, Roger. I really appreciate it. I really hope that this webinar was useful in helping you guys better understand the strategy, because it is one of the core strategies in my trading with options, and it's a core strategy because it's easy, it's relatively simple to manage, and it's very efficient in allowing you to take a directional view. Now, not every time do you have a strong directional view. Sometimes you just think a stock's not going to move very much, and guess what? There's a whole different set of strategies for that. That's what we're going to cover next week. So I really hope to see you guys there next week. For those of you, a lot of you asked about selling options or selling put spreads. We're going to cover that next week. So again, very different strategy, but useful in very different market environments. So with that, I want to thank everyone for taking the time out here this afternoon. I really hope that you guys have found this webinar useful. One of my favorite strategies. So I will send out the webinar, the recording to everyone in about 30 minutes. And I hope you guys have a great evening, and I'll see you next weekend.